Okay, let's unpack this. Today we're doing a deep dive into CRH PLOC. Now this is a huge company, but maybe not a name you immediately recognize.
Yeah.
If you're prepping for a meeting, maybe managing an infrastructure portfolio, or honestly, if you're just curious about where the real value gets created in the U.S. economy, well, this is your shortcut. You probably rely on CRH's materials pretty much every single day.
It's a
Delta
list.
Roads, yeah. They supply cement for data centers, the ones housing your cloud data. And they provide critical infrastructure components, basically the stuff that keeps modern life running. They're sort of the industrial giant hiding in plain sight.
Absolutely. Hidden in plain sight is a great way to put it.
And the whole scenario around CRH is one of the most compelling valuation puzzles we've looked at recently. I mean, think about it. Here's a company generating a massive 3/4 that's 75% of its operating profit right here in the North American market, which is economically pretty robust. It has just unparalleled scale, and this is crucial. It has an elite, decades-long track record, a real capital compounder. Yet for years, it's been trading at this significant, really noticeable discount compared to its direct U.S. peers, the pure play guys like Martin Marietta and Vulcan Materials.
Right, a discount that just didn't seem to square with the fundamentals.
Exactly. So our mission today, it's complex, but it's clear. We need to analyze the transformation CRH has really completed. We need to detail the deep competitive advantages they have, prove their, frankly, incredible financial resilience against recent economic headwinds, and analyze that massive strategic catalyst, the big one, moving its primary listing fully to the New York Stock Exchange, which they explicitly designed to unlock shareholder value, right, to close that persistent valuation gap.
That's absolutely right. And the core of our sources for this deep dive, they really center on a detailed investment analysis, one that initiated a strong buy rating on CRH, precisely because this valuation dislocation, it's seen as a clear, almost near-term arbitrage opportunity. It's not often you find, a world-class operator trading at a discount just because of where its stock used to be listed.
Just geography, basically.
Pretty much. And the analysts, they identified 4 key pillars supporting the whole investment thesis. The reason why this story is so potent right now, first, it's their unmatched scale and really radical vertical integration. Together, these create an exceptionally deep competitive moat, secure supply, give them pricing power. Second, you have to emphasize their history. They are a proven capital compounder. I mean, delivering a remarkable 16% annualized total shareholder return since 1970, that's elite performance, over half a century.
16% annualized since 1970 is.
Yeah, that's serious compounding.
Yeah.
It really is. Third, they've got prime exposure to long-term secular growth trends. And I'm talking multi-decade trends here. Things like the rollout of the $1.2 trillion IIJA infrastructure funding, also the growing demand for massive data center construction, and the broader U.S. reindustrialization push. They're right in the middle of all that. And finally, there's that pivotal factor, the significant valuation dislocation tied directly to their historical European listing. We see that as an actionable, almost self-imposed catalyst for future upside. So what we're examining is an industrial machine really built for compounding that the market is finally being forced to recognize.
Okay, let's start digging into that strategic pivot then. From Irish roots to becoming this North American powerhouse. To really get the scale of this pivot, we have to go back to the beginning, right?
You need the history.
The company name, CRH, it's an abbreviation for Cement Roadstone Holdings, officially set up in 1970. And it came from a merger of 2 foundational Irish companies, Cement Limited, which actually goes back to 1936, and Roadstone Limited, starting in 1949.
So deep roots in Ireland.
Deep roots. But unlike a lot of companies that might focus on slow, organic growth, CRH's fundamental strategy right from the get-go was built on M&A. Disciplined, programmatic M&A. This long-term compounding acquisition strategy, that's what first led them across the Atlantic. They entered the U.S. market way back in 1978. Now, this wasn't just, opportunistic buying. The sources we looked at describe M&A as the central, the defining pillar of their long-term value creation.
And that strategic M&A, it only picked up speed over time. They weren't just nibbling around the edges. They executed these highly transformative deals that really cemented their dominance in North America. A great example, that huge $6.5 billion acquisition of assets from the Lafarge-Holcim merger back in 2015. They managed to grab crucial, large-scale, vertically integrated assets, fundamentally change their footprint. Then they followed that up, strategically buying the U.S. cement maker Ash Grove Cement in 2018.
So big, bold moves.
Exactly. And what this shows is a management team really focused on asset quality and strategic integration. They aren't just buying companies randomly. They're acquiring long-life, frankly, irreplaceable mineral reserves, and then plugging them immediately into their vertically integrated network, making sure those acquisitions start adding value,
They
from
get
day one.
hitting ground running. And all that history, all that strategic accumulation of assets, it was all just the buildup to what we're really focusing on now, which leads us to that pivotal moment, the formal transition of their primary listing to the New York Stock Exchange. They finished that on September 25, 2023.
Yeah, and you really cannot overstate the significance of this. This was the capstone, the final piece of a decades-long strategic shift that literally redefined CRH's corporate identity. I mean, look at the numbers. The message is just undeniable. Roughly 75% of the entire group's EBITDA is now generated in North America. So by moving the primary listing to the NYSE, management is directly aligning the company's valuation currency, its investor base, with its operational center of gravity. It just makes sense.
Okay, I get aligning the market with where the money's made. But let's dig into that valuation dislocation you mentioned earlier. We hear conglomerate discount thrown around.
Yeah.
But for someone listening, what exactly was it about the European listing that punished a company clearly operating like a premium U.S. industrial?
That's a really great question, and it's key to understanding the opportunity here. Historically, when CRH traded mainly on European exchanges, two things happened. First, it got benchmarked against the wrong peer group. European industrial sectors, they generally see slower growth, right? And they often trade at significantly lower earnings multiples, maybe 10 to 12 times earnings. Compare that to the high-growth U.S. infrastructure peers, the ones benefiting from these secular tailwinds. They trade in the high teens, even low 20s on an EBITDA basis. Huge difference.
So wrong neighborhood, basically.
Wrong neighborhood, exactly. Second, because CRH was still carrying these smaller legacy European and Asian segments, the market applied that classic conglomerate discount. The market hates complexity, right? It couldn't clearly see or isolate the immense profitability and growth coming just from the U.S. operations. So it penalized them for being diversified rather than rewarding them for being dominant in North America. The NYSE move, its management saying, loud and clear, look, we are no longer a European conglomerate. We are a premier U.S. infrastructure play, and we demand to be valued like one. It forces the market to put them side by side with Martin Marietta and Vulcan.
Okay, that makes sense. The signal is sent, the listing is moved. Now let's get into what they actually own and operate in the Americas. If this business is pulling in 75% of the profit, it must be an absolute machine. Walk us through the anatomy of CRH Americas. How's it actually put together?
Right, structured for efficiency, really designed to capture profit. It runs in two main segments under the CRH Americas umbrella. And remember, CRH Americas is the engine here. It vastly outperforms the smaller CRH International division handling Europe and Asia. The first segment is the foundation, Americas Materials Solutions. This is the vertically integrated core. They are the clear #1 player in aggregates and asphalt in North America. Think foundational building blocks, crushed stone, sand, cement, asphalt mix, ready-mixed concrete. The sources really emphasize their dominance in what they call road solutions. This is where that massive scale and high asset utilization really come into play.
Got it. The core materials. And the second segment.
That would be America's Building Solutions. Now, this part focuses on higher margin, value-added products. It's not just selling raw stuff, it's selling finished, often critical components. This includes utility infrastructure solutions, think precast concrete, specialized systems protecting vital water and energy networks, and also outdoor living solutions, things like high-end pavers, wall systems, composite decking materials. These products command higher margins because they solve a specific problem, or they tap into, discretionary consumer spending on home improvement, which tends to hold up better than raw commodity prices.
What's really striking, and it just highlights that whole strategic shift, is this efficiency paradox you see in the geographic footprint. The sources note, Americas account for just 59% of the workforce and 52% of the total operating locations globally.
Right.
But they generate that massive 75% of the company's total profits. I mean, the American assets are just disproportionately productive and profitable compared to everything else.
And that disparity, that difference, it brings us straight to the company's primary competitive advantage, the power of that vertical integration. It creates this powerful self-reinforcing system, what some people call the flywheel effect. See, the system runs from the very beginning of the supply chain, the upstream essential materials, which basically means owning the quarry all the way downstream to the paving and building solutions they offer. Because CRH owns the quarry, they secure a reliable, low-cost supply of aggregates for their own downstream asphalt and concrete plants.
Okay, so how does owning the quarry translate into beating a competitor who maybe doesn't own one?
Well, it creates a margin buffer, first off, and ensures security of supply. Because their own supply costs are locked in and favorable, CRH can submit highly competitive bids on big, multi-year construction and paving projects. They can afford to undercut competitors who have to go out and buy raw materials from third-party quarries at market rates. Winning those large projects, in turn, drives much higher volumes through CRH's own quarries and processing plants. This improves asset utilization, lowers the unit costs of everything they produce. It's a virtuous cycle. It's a durable, margin-enhancing advantage that non-integrated competitors just can't easily match.
We've established vertical integration is key, but let's talk about the physical barriers to entry. You mentioned the industry is structurally local because things like crushed stone are heavy and cheap per ton. Right?
Exactly.
So if you have to truck that stuff more than, say, 30 or 50 miles, the transport cost just wipes out the profit. Location becomes everything.
Precisely. Think of their business model less like a global supplier and more like a network of highly localized monopolies almost. A quarry's effective competitive radius is really short. CRH has over 2,000 locations in the Americas. That sheer geographic density is an irreplaceable asset, especially in and around major cities where construction activity is highest. But the real long-term value, I think, is locked up in the mineral reserves themselves. These are long-life permitted quarries. Because of extreme regulatory hurdles, environmental scrutiny, increasing community opposition, MEism, not in my backyard, getting permits for new quarries today is exceptionally difficult. It's lengthy, it's expensive, often takes a decade or more. So CRH's existing permitted land, that's a finite and highly defensible asset base. It's a huge barrier to scale for any competitor.
That structural scarcity, it sounds like it protects them from almost any new entrant. But CRH isn't just sitting on old assets, are they? They're actively reinforcing that moat through acquisitions focused on the future, specifically sustainability and low-carbon construction.
Absolutely. And what's fascinating here is the forward-looking strategy you see in that 2025 $2.1 billion acquisition of Eco-Material Technologies. Eco-Material is North America's leading supplier of what they call supplementary cementitious materials, or SCMs, primarily fly ash. Now, this stuff is a critical ingredient for making concrete with a lower carbon footprint, and it's becoming increasingly scarce as coal-fired power plants continue to shut down.
Right. Less coal burning, less fly ash.
Mm-hmm.
The sources suggested this eco-material deal was kind of a masterstroke, achieving 4 goals at once. Let's break those down because they say a lot about CRH's long-term thinking. First goal, securing supply.
Yes. It fundamentally deepens their vertical integration. They're securing a critical input SCMs for their own concrete operations. They're essentially future-proofing their supply chain against the growing scarcity of these low-carbon materials. Think about it. In a world where every major infrastructure project will eventually demand greener materials, controlling the supply of SCMs, that's a massive advantage.
Okay, makes sense. Second goal relates more to the market and regulation, which is increasingly pushing for sustainability.
Right. By controlling the leading supplier of SCMs, they gain a huge competitive advantage as environmental regulations inevitably tighten, and customer demand for sustainable building solutions just grows exponentially. This positions CRH as arguably the undisputed leader in the green construction transition. It lets them potentially capture premium pricing for lower carbon concrete mixes down the line.
And the third goal sounds like pure revenue diversification and growth.
Precisely. It opens up a whole new high-growth revenue stream. They can now sell these essential SCM materials to third parties, including their direct competitors. They become the indispensable supplier of a critical component to the entire North American concrete industry. They profit whether their competitors use it or not.
Interesting. Kind of like selling shovels during a gold rush. And finally, the fourth goal ties back to capital markets and perception.
Exactly. It materially improves CRH's overall ESG profile. Environmental, social governance. This is crucial for attracting the vast pools of institutional capital that operate under ESG mandates. By positioning themselves as a leader in sustainable construction, they attract a broader, potentially lower-cost pool of capital, which reinforces their whole valuation argument in the U.S. market. It's integration, supply chain security, profit growth, and better capital positioning all rolled into one deal. It really demonstrates some incredible management foresight.
Okay, so they're strategically positioning themselves brilliantly. But let's talk about the recent past, the operating environment for construction between, say, 2023 and 2025. It was extremely tough, wasn't it? They navigated some serious macroeconomic headwinds.
Oh, absolutely. This wasn't a gentle market by any stretch. The company really navigated a confluence of significant challenges.
Let's tick through those headwinds, starting with costs.
Okay, first, you saw serious cost inflation across the board. Overall, building materials costs surged, something like over 35% since early 2020. Steel, which is crucial for rebar and structures, was up over 125% at points. Huge jumps. On top of that, you had the impact of rising interest rates, which really peaked in late 2023. This jacked up the cost of capital for developers, right? So it dampened demand in those rate-sensitive private sectors, residential housing, speculative commercial real estate, led to project delays, sometimes outright
And
cancellations.
the labor situation wasn't helping either.
Not at all. That was the third headwind. Labor constraints. The industry was structurally strained. Reports from 2025 showed that something like 94% of construction firms were struggling significantly to find qualified workers. This puts sustained upward pressure on wage costs, naturally. But importantly, it also slows down project completion times, which can create friction with clients. So yeah, basically everything was getting more expensive and harder to build.
That sounds like a textbook recipe for severe margin compression. You'd expect that in an industrial commodities business facing those pressures. But here's the truly remarkable part, and you touched on it earlier. CRH delivered its 11th consecutive year of margin expansion in 2024, doing that for over a decade, especially through a period of hyperinflation. That speaks volumes.
It speaks volumes about the durability of their pricing power, which, again, is a direct consequence of that vertical integration we discussed. The sources, they attribute this resilience to, quote, disciplined commercial management, which is basically management speak for knowing exactly when and how much to raise prices. They leverage positive pricing momentum and just relentless operational efficiencies. And we have hard proof of this pricing power. In early 2025, CRH realized price increases of 8% in aggregates and 4% in cement. When a company can not only pass through 35% cost inflation but still expand its margins, it just underscores how essential their products are and the non-substitutable position they hold in their local markets.
That operational discipline, it translated directly into really stellar financial performance in 2024. Can you give us the headline figures again?
Sure. For the full year 2024, they reported total revenues of $35.6 billion. Adjusted EBITDA came in at $6.9 billion, which was a robust 12% increase year over year. And crucially, the adjusted EBITDA margin expanded by 180 basis points, that's 1.8 percentage points, to hit 19.5%.
And that 180 basis point expansion, what does that really tell us about the health of the business?
It shows their revenue growth outpaced their cost increases, so they achieved greater operating leverage. It's the tangible proof that their competitive moat is effective, even when the tide of inflation is running hard against them. And what's more, that momentum isn't slowing down. Management has already reaffirmed guidance for another record performance in 2025. They're projecting adjusted EBITDA somewhere in the range of $7.5 billion to $7.7 billion for the full year.
Beyond a profit line, CRH is known as a highly cash-generative business. They reported $5.0 billion in net cash from operating activities in 2024. That's significantly higher than their net income of $3.5 billion. Why is that gap important?
That distinction between net cash from operations and net income, it's critical, especially in a capital-intensive sector like this. The difference often comes down to non-cash charges, things like depreciation and amortization. The fact that their cash from operations is consistently and significantly stronger than the reported net income, that's a classic indicator of high-quality earnings and really robust financial management. It tells you the company isn't just profitable on paper, it's generating substantial, real, deployable cash.
Okay, and how does that cash flow relate to what they need to spend just to keep the business running?
Well, the sources indicate that maintenance capital expenditure, so the spending required just to sustain the business, not necessarily grow it, is relatively low. Only in the range of 34% to 38% of that massive 2024 cash flow from operations. This leaves a significant amount of free cash flow available for growth investments, for M&A, and critically for shareholder returns. That robust cash profile, it really underpins their entire growth strategy moving forward.
Yeah.
And if we connect this strong performance back to the bigger picture, CRH isn't just surviving these macro challenges, it's perfectly positioned to capitalize on long-term secular tailwinds in North America.
Right, they call themselves the #one infrastructure play in North America. What specific drivers are they really banking on?
Well, the most obvious one, and probably the most durable driver, is the Infrastructure Investment and Jobs Act, IIJA. This isn't some short-term spending burst. It provides a reliable, multi-year demand floor for their core materials, aggregates, asphalt, cement. The key data point here is the runway. Less than 40% of the $1.2 trillion allocated for IIJA highway funding had actually been deployed as of mid-2025. That means there's a massive, guaranteed pipeline of demand still coming over the next 5+ years, disproportionately benefiting large, integrated suppliers like CRH.
Okay, so government spending on roads and bridges is a big one. What about the industrial side of the economy?
That's where the reindustrialization trend really kicks in. The U.S. is seeing enormous capital deployment into domestic manufacturing, think chip fabrication plants, driven by the CHIPS Act, and also large-scale essential tech infrastructure like data centers. CRH is a key supplier to these high-growth segments. These are complex, multi-million, sometimes billion-dollar projects. They naturally favor CRH's integrated solutions model, which can provide a comprehensive, reliable suite of materials and products all under one roof, basically.
And we know M&A is still the inorganic growth engine. We heard about 40 acquisitions in 2024 alone. That sounds almost frenetic.
It might sound hectic, but it's deeply strategic. They deployed $5.0 billion across those 40 what they call value-accretive acquisitions in 2024. See, CRH leverages its immense scale and its deep integration competency to be the acquirer of choice in what's still a highly fragmented industry. Because they can immediately plug a newly acquired quarry or plant into their existing logistics network, they instantly generate synergies that a standalone buyer just couldn't achieve. This is compounding capital at scale, systematically.
The confidence management seems to have in all these drivers. It really culminates in those ambitious 5-year targets they laid out at their 2025 Investor Day, looking out to 2026-2030. What exactly did they promise the market?
They set very clear performance metrics. They're targeting average annual revenue growth of 7% to 9%. Now, that's high-end growth for a company of this size and maturity. They're also projecting further significant expansion of their adjusted EBITDA margin, aiming for a range of 22% to 24% by 2030, getting to a 24% margin in this sector. That would absolutely solidify their position as a top-tier performance leader. But perhaps the most telling figure, the one that speaks to their cash generation and M&A capacity, is their financial capacity projection. Management identified approximately $40 billion of total financial capacity available over those 5 years.
$40 billion
Yeah.
over 5 years. That's an incredible number. What does that signal to you or to a listener?
It signals they have the firepower to continue their compounding strategy very aggressively while also rewarding shareholders significantly. That capacity gives them enormous flexibility. They can invest heavily in CapEx if needed. They can execute on more large, transformative acquisitions like eco-material, or they could significantly ramp up shareholder returns through buybacks or dividends. It really highlights the scale of their ambition to keep compounding capital at a rate that likely far exceeds the sector average.
Okay, this phenomenal performance, this massive future capacity, it brings us right back to the core mystery we started with, the valuation argument. That quantitative data on the gap between CRH and its U.S. pure-play peers, that's the real aha moment that seems to validate the whole NYSE listing strategy.
Yeah, let's lay out the specifics using common valuation multiples. If we look at trailing 12-month price-to-earnings ratios, PE ratios, basically how much the market pays for a dollar of recent earnings, the gap is just massive. CRH trades at roughly 25.1 times earnings based on the data we have. Now compare that to its closest, most relevant U.S. peers in aggregates and materials. Martin Marietta, MLM, trades around 36.1 times earnings, and Vulcan Materials, VMC, trades substantially higher at 42.3 times earnings.
Wow, that is a staggering discount. Especially when, as the analysis points out, CRH is actually showing superior operational results in some ways. Their return on equity is 15.2%, which is higher than Martin Marietta's 12.2% and Vulcan's 11.9%.
Exactly. And the discount holds true even if you use a metric that adjusts for debt, like enterprise value to EBITDA. CRH trades around 13.1 times TTM EBITDA. Martin Marietta is up at 19.8x, and Vulcan is even higher. This clearly shows the market was applying a heavy discount, probably in the range of 30%, 40% against its U.S. peers, likely just because of that historical European listing and the perceived complexity.
So the conclusion, the hope, is that the re-rating catalyst moving the primary listing to the NYSE is designed specifically to close that gap. The analysis we're drawing on suggests this could unlock potential upside of maybe 20–30%, simply as the market sheds that old conglomerate discount and finally prices CRH as the premier U.S. industrial it seems to be operating as.
It's the ultimate self-help value unlock, right? Now let's pivot slightly to how they manage all that cash flow we talked about. Management operates under a very disciplined, very balanced capital allocation framework. They prioritize 3 things, generally in this order. First, aggressive reinvestment into value-accretive M&A and necessary CapEx. Got to feed the beast. Second, maintaining a fortress-like investment-grade balance sheet. That gives them strategic flexibility. And third, only then returning excess cash to shareholders.
Okay, so how does that look in practice in terms of direct shareholder returns?
Well, they're executing pretty aggressively on that third pillar lately. They returned a substantial $3 billion to shareholders in 2024 alone. That was through a combination of progressive dividends and programmatic share buybacks. They recently increased their quarterly dividend by 6% to $0.37 per share, signaling confidence. And they operate an ongoing systematic share buyback program currently running a $300 million quarterly tranche. This consistent capital return acts as a steady source of demand for the stock and, importantly, signals management's absolute confidence in their future cash flow generation.
We've laid out an almost, well, near-perfect investment thesis here, it seems. But we have to maintain some critical distance. Every investment has risks. What are the key risks that could potentially disrupt this positive story?
That's fair. The primary external risk is always the cyclical nature of the construction industry itself. While the IIJA provides a strong demand floor, a severe or prolonged recession could still significantly hit that rate-sensitive private residential and commercial activity. We also have to watch for political or fiscal shifts, things that might delay or even reduce future government infrastructure funding, though that seems less likely right now with the IIJA locked in. Internally, the risks mostly center on that massive M&A engine. Given the sheer volume, you mentioned 40 acquisitions in 2024, there's always a risk of M&A execution failure. That means either overpaying for an asset, which destroys capital right away, or failing to successfully integrate those acquired businesses and actually realize the projected synergies. That would undermine the whole margin expansion story. They really need flawless execution to justify that volume of deals.
That integration risk, it brings us back to management. If they're juggling 40 deals a year while simultaneously driving record margin expansion through inflation, they must have some kind of operational secret sauce. Which raises an important question. Is the management team truly aligned with closing that valuation gap? And how on earth do they manage such a vast, dispersed operation effectively?
The sources suggest very strong alignment, actually. Start at the top with CEO Jim Minturn. His compensation structure is heavily performance-based, weighted towards variable pay tied directly to company performance metrics. He also owns significant shares himself, valued around $4.29 million, according to the analysis. That gives him a powerful vested interest in the long-term compounding story, not just hitting short-term numbers. But the true operational genius, the secret sauce, as you called it, seems to be their decentralized management philosophy. Now, this might sound counterintuitive for a massive global company, but it's precisely what enables both the M&A velocity and the margin expansion. Remember, the industry is structurally local. Success depends on hyper-local knowledge, knowing which quarry nearby has the lowest costs, which competitor might be ripe for acquisition, what local pricing the market can actually bear.
So instead of rigid top-down mandates from headquarters in, say, Dublin or now maybe somewhere in the U.S., the local managers have real autonomy.
Exactly. The decentralized structure empowers those local and regional managers, the ones who have deep ingrained knowledge of their specific, maybe 30-50-mile radius markets, to act quickly and decisively. This allows the global giant, CRH, to operate with the agility and responsiveness of a much smaller local player. This is a foundational, maybe unquantifiable advantage. It helps them execute M&A almost seamlessly, maintain that essential local pricing power we talked about, and consistently drive that margin expansion even when facing tough inflationary pressures. It's probably what allows them to absorb 40 companies in a year without getting severe operational indigestion.
Makes sense, empowering the people on the ground.
Okay, so to wrap this up, to summarize our deep dive for you, the listener, CRH has fundamentally transformed itself. It's really no longer accurate to think of it as a diversified European industrial. It is now, operationally and strategically, a dedicated North American infrastructure growth story. That 75% of profits coming from the region is the proof. The move of their primary listing to the NYSE, that's a clear, self-imposed strategic action. It's designed to force the market to finally close that significant quantifiable valuation gap that exists between them and their U.S. peers.
Seems pretty clear-cut when you lay it out like that.
And furthermore, its core competitive advantages, that powerful flywheel of vertical integration, the irreplaceable permitted asset footprint that's incredibly hard for competitors to replicate, and their disciplined, high-volume M&A strategy, all these make its market position highly defensible. And its future earnings should be exceptionally durable, even as they likely weather future economic headwinds. The value unlock feels, well, almost imminent.
As we reflect on this, the unique nature of the building materials sector, where the products themselves are basically commodities, right? Stone is stone. But local market density and asset scarcity are absolutely everything. Consider this final provocative thought. CRH's business is fundamentally protected not by flashy marketing campaigns or the next big technological breakthrough, but by two really simple, almost mundane facts.
Yeah.
Physics and regulation.
Physics and regulation. Interesting way to frame it.
Simple physics dictate that their heavy products just cannot be cheaply transported long distances. That inherently creates these defensible local monopolies, or near monopolies. And complex, often burdensome regulation makes permitting new mineral reserves, new quarries, almost impossible in many desirable areas. So the final thought for you to maybe explore on your own is this. If those new quarries are indeed so difficult, so expensive, so time-consuming to permit, how much intrinsic long-term value is truly locked up in CRH's existing vast permitted land assets? And is that highly defensible, long-life value still underappreciated by the market, even after the expected re-rating that this NYSE listing is designed to trigger? It's a compelling question, I think, for anyone focused on finding assets that can compound wealth steadily, almost regardless of short-term market noise.